The trading day is closed, and Plug Power Inc., under the ticker PLUG, finished the last session on Friday, November 28, 2025, with a closing price of $2.01 per share. The stock experienced a slight bump in the after-hours market, inching up to $2.02, which represents a minimal movement, but the key takeaway from the preceding session was a solid 1.8% gain on Friday. However, the unexpected twist for many who watch this name is not the percentage gain on a quiet trading day, but the sheer volume that drove it, coupled with the critical shareholder vote coming up. On Friday, the stock moved with a volume that was notably below its average, suggesting that the marginal push higher was not the result of a massive buying spree, but rather a subtle accumulation or a brief pause in selling pressure in a very low-conviction market environment for this name. This quiet uplift comes immediately after the company announced a special meeting of stockholders scheduled for January 15, 2026, where a proposal to significantly increase the authorized common stock from 1.5 billion to 3 billion shares will be voted upon. This is the unexpected angle. Investors are bracing for potential future dilution, yet the stock is not immediately collapsing, which creates an inherent tension in the narrative. The general market expectation for Plug Power, particularly among retail investors who track the stock closely on forums like Reddit's various investing communities and X, formerly Twitter, is split into two intensely polarized camps. The hydrogen bulls see the company as the necessary infrastructure backbone for a future green hydrogen economy, believing that its end-to-end ecosystem, from electrolyzers to fuel cells and hydrogen production, represents an asset that governments and major corporations will be forced to utilize as decarbonization targets intensify globally. This expectation is fueled by big headline-grabbing announcements, such as new electrolyzer deployments in Europe or the recent pivot toward providing stationary power for the rapidly growing energy-hungry AI data center sector, which has been cited as a potential massive new revenue stream. The core belief here is that the company's playing a long, expensive game where current losses are simply the cost of building a monopolistic future infrastructure. The reality, however, is a deeper and far more challenging one, particularly when looking at the core financials and the short-term stock price action. The technical picture is grim. While the stock has seen massive volatility, moving from a 52-week low of 0.69 to a high of $4.58, the prevailing trend is a brutal descent from those highs, indicating sustained, heavy selling pressure. The recent Q3 2025 earnings report, while showing a slight beat on adjusted earnings per share at a loss of 0.12 versus an expected loss of 0.13, was overshadowed by a revenue miss and, more critically, continued large GAAP gross losses. The sequential increase in GenEco electrolyzer revenue was a bright spot, demonstrating commercial traction, but the headline remains the negative gross margin and the massive cash burn. This is the truth that challenges the bullish expectation. A strong commercial product line is meaningless if the business model cannot turn a profit, which is why the stock price remains grounded near the bottom of its yearly range. The market is not yet convinced that the Project Quantum Leap restructuring initiative, designed to improve margins and reduce cash burn, can deliver profitability fast enough before the company runs into another liquidity crunch. A significant part of the current stock's reality is dictated by the constant capital raises and the shadow of dilution. The recent successful pricing of a $375 million convertible senior notes offering, while allowing the company to retire some higher-cost debt, immediately prompted a sharp sell-off, which is a textbook reaction to the fear of future dilution and debt overhang. Now, the forthcoming vote on doubling the authorized shares is not merely a formality, it is management preparing the runway for massive future financing, likely through an at-the-market equity program. The fact that the company is asking for this flexibility is a direct acknowledgement of the high operational burn rate and the cost of scaling its large-scale hydrogen production and delivery network. The expectation that Plug Power has fully funded its current business plan following the recent notes offering is immediately put under tension by the need to authorize 3 billion shares. Prudent investors must look beyond the press release and see this as a necessary financial safety net due to ongoing substantial losses. This is the core reason for institutional hesitancy and the stock's poor performance despite sector tailwinds. Now, we must address the elephant in the room that is central to the retail investor debate: short-selling activity. Plug Power is one of the most heavily shorted stocks on the Nasdaq, and the recent data confirms that it remains under significant pressure. As of the most recent settlement date, short interest was exceptionally high, hovering around 305 million shares. When compared to the float, this represents a major percentage of the tradable stock, signaling profound institutional bearish sentiment. The days-to-cover ratio is currently sitting in the low to mid-single digits, around 2.5 days, which is critical. While a higher days-to-cover can signal a greater potential for a short squeeze, because it would take shorts longer to buy back shares, the current numbers suggest that while short interest is high, the liquidity is generally sufficient for short sellers to cover quickly in a pinch, dampening the immediate risk of a massive short squeeze. However, the high short interest itself, which is noticeably greater than many of its peers in the alternative energy sector, indicates that major firms believe the stock's valuation is fundamentally detached from its current financial reality of high burn and no profitability. Short sellers, including some notable quantitative funds, are betting on a continued decline fueled by repeated capital raises and macroeconomic pressures that could slow the global hydrogen adoption timeline, specifically delays in government clarity on hydrogen transport and subsidy programs, as we've seen recently with projects in the UK. For retail investors tracking this short activity, the actionable insight is to monitor the borrow rate, the cost for a short seller to borrow shares, which can often spike just before a coordinated short report or a potential covering event. You can often find this data on broker platforms or specialized financial data services. A sudden, sustained spike in the borrow rate, paired with a rising days-to-cover ratio, is a far more powerful signal of an impending short squeeze risk than just the absolute number of shorted shares. Furthermore, look at the upcoming proxy statement filed for the January special meeting. Plug Power itself recently addressed the high short interest, stating that a significant portion of shares on loan to short sellers comes from retail accounts. This is a subtle but important warning. When your shares are loaned out, you lose the right to vote on critical corporate matters, such as the share authorization proposal. For investors who believe in the company's long-term vision, ensuring your shares are not being lent out is a direct way to counter the institutional short thesis and retain your voting power, which is a non-trivial issue right now. The underlying business, divorced from the daily stock volatility, is centered on providing comprehensive hydrogen solutions. Plug Power makes proton exchange membrane or PEM electrolyzers, which create green hydrogen from water and renewable electricity. They also produce GenDrive fuel cell systems that replace traditional batteries in electric material handling vehicles, think forklifts, for major customers like Walmart and Amazon. Their business model is a two-pronged approach: selling the equipment, electrolyzers and fuel cells, and selling the fuel, green liquid hydrogen, via their vertically integrated network of production plants and fueling stations. The equipment sales are one-time revenue events, but the fuel and service contracts represent the high-margin recurring revenue that the bull case hinges on. The issue is that building this infrastructure, from the plants in Georgia and Louisiana to the fueling stations across the continent, is extraordinarily expensive and is the primary driver of the negative free cash flow. This capital intensity, rather than any flaw in the technology itself, is the bear thesis that the shorts are capitalizing on. Looking to the future, the primary catalysts fall into two categories: external policy support and internal execution. On the external side, the clarity and finalization of the U.S. government's rules around the 45V clean hydrogen production tax credit are critical. Tighter rules could restrict the definition of clean hydrogen, making Plug's current production more expensive or less profitable, while looser rules would provide a significant immediate profitability boost. On the internal side, the key is the new management's ability to demonstrate a clear path to positive gross margins and eventually free cash flow. The pivot to data centers, where large tech companies need massive, reliable, carbon-neutral stationary power, is a high-opportunity area that could provide large, stable contracts. However, the market needs to see signed deals, not just statements of intent. The question is whether they can transition their business from material handling, which is a mature and lower growth segment, to large-scale stationary power and industrial applications quickly enough. The market debate